stocks, mutual funds, ETFs, how much tax do they attract? And how are they taxed after the budget 2024? And what is the impact of these changes on the public? Whether it's equity delivery, intraday trading, or futures options, we'll simplify everything and break it down so you can understand it very easily in this video. Welcome to mindsync, your compliance guard. mindsync is a professional organization providing compliance, consulting, legal and advisory services. When it comes to stocks, mutual funds, and ETFs, two types of taxes are generally considered. First, transaction tax, called the securities transaction tax (STT). This applies whenever you buy or sell. Capital gains tax. This applies to the income generated from shares or mutual funds. Let's start with the securities transaction tax in different scenarios. Equity delivery. When you buy or sell shares for delivery. Delivery means holding a stock for more than one day. The STT will be 0.1% of the transaction value. Next, intraday trading. If you buy and sell on the same day, the STT at the time of sale is 0.025% of the transaction value. Mutual funds, exchange traded funds. Whenever you sell a unit of mutual fund or ETFs, the STT is 0.001% of the transaction value. Next, let's see futures options. For futures, the STT is now 0.02% when sold. For options, the STT has increased to 0.1% when sold. Capital gains tax. Now, let's discuss capital gains tax when you sell stocks, mutual funds, or ETFs. For equity mutual funds and ETFs, where most of the money is invested in shares, the tax treatment is the same as for stocks. There are two categories depending on your holding period. Short-term capital gains. If you sell before 12 months, the tax rate has increased from 15% to 20%. Long-term capital gains. If you sell after 12 months, the tax rate has increased from 10% to 12.5%. However, there is an exception limit. The long-term capital gain exemption limit has been increased from Rs 1 lakhs to Rs 1.25 lakhs. For example, let's consider Kiran, a trader or investor. Kiran invests Rs 10 lakhs and sells his investment after 11 months for Rs 11 lakhs. The 1 lakhs gain is short-term capital gain, taxed at 20%, resulting in a tax of Rs 20,000. If Kiran holds the investment for 13 months and makes a 1 lakhs profit, it's now long-term capital gain. Since the exemption limit is Rs 1.25 lakhs, there's no tax. But if Kiran earns Rs 2 lakhs after 13 months, the first 1.25 lakhs is exempt and the remaining 75,000 is taxed at 12.5%, amounting to Rs 9,375. Next, let's jump into capital loss. If you incur a capital loss, you can claim a set-off. For example, if Kiran has 2 lakhs in long-term capital gain, but a loss of Rs 50,000 from other stocks, the net taxable gain is Rs 1.5 lakhs. After applying the 1.25 lakhs exemption, the taxable amount is Rs 25,000, taxed at 12.5%, resulting in Rs 3,125 tax. But there are certain conditions to remember. Long-term capital losses can be set off against both long-term capital gain and short-term capital gain. But short-term capital losses can only be set off against short-term capital gain, not long-term capital gains. Also, these losses can be carried forward for 8 years. But there is a catch: you can only claim losses if declared in your income tax return (ITR). Next, let's look into intraday trading. For intraday trading, the income does not fall under capital gains. Instead, it is classified as business income. It falls under the speculative income category and is taxed according to your income tax slab rate. For futures options, the income is also business income, but it is classified as non-speculative income. We've covered all the latest updates. If you'd like to know more ways to save on taxes or have further queries, feel free to contact us. Like, share, and subscribe, and hit the bell icon for more such informative content.